Hello, my name is Paul Darrow. I'm president of PhD Financial, a creative financial solutions firm. Due to this fantastic technology, I'm very pleased to be able to be here with you today. Let me tell you a little bit today about what PhD Financial offers with its creative financial solutions. Our services are full-service hospitality consulting and business consulting. We refinance existing properties, we finance new builds or purchases, we restructure debt of existing properties. In order for us to do this effectively, we have in-house attorneys, CPAs, and certified hotel administrators. The types of loans that are available to commercial properties today are conventional lending. You go to your local bank, 65 to 70% loan to value. We also have SBA funding, 80 to 90% loan to value. An SBA loan is basically a conventional loan that's guaranteed by our government. When that loan, for whatever reasons, becomes non-performing, the government repays the lender 80% of its value. An SBA 504 loan is again a government-guaranteed loan. However, it can only be used for purchases. The 504 program was defunded back in 2012 for refinancing. The government is considering bringing the refinance portion of the SBA 504 loan back. CMBS money or loans are 65% loan to value. They are non-recourse, meaning there's no personal guarantees on those loans. Hard money loans are loans that are used, or bridge loans, are used to purchase properties that are needing to be closed very quickly in a time frame that could not be done through SBA or conventional lending. These loans are more expensive, however, you're in them for a short period of time, and you have to take that additional expense and amortize it over the term of the loan to determine its real cost. PACE funding is a new funding opportunity for green improvements to either existing properties or older properties that are being redone to put in solar, low flush fixtures, lighting. Any of those kinds of improvements can be done through PACE funding. Those costs can be financed at 100%, 6% money, 20-year term. It's a great product, and if you'd like to speak about any of these products, please feel free to contact me. The documents required for financing these days are 3 years of personal and corporate tax returns, a completed signed loan application, 3 years of professionally prepared financial statements, personal credit reports, personal financial statements on all borrowers with 20% more equity in the property, resume of all key employees, franchise agreements, latest STAR reports, appraisal if available. I always suggest getting your own appraisal. It gives you a basis for your loan, and copies of all notes if this is a refinance. How do you protect your asset? Well, you have to have your loan documents and other documents reviewed prior to signing. Please get a good attorney who's familiar with these kinds of transactions. We can help you with that, or you're certainly free to find your local one. Preparation of your articles of incorporation are to include your bylaws, your organizational minutes, your annual meeting to ensure all corporate formalities are followed, preparation of your operating agreement for your LLC, and preparation of a shareholder agreement. These documents are necessary to protect your asset and to protect you from liability. If you don't do these things, you take the chance of doing what's called piercing the corporate veil. When that happens, you lose the protection of your LLC or your corporation. How we save you money: accounting, real-time financial services, daily reports, management reports, and owner reports. Have your monthly bank reconciliations done. Establish internal control procedures and audits. Accounts payable by purchase order, and budgets and forecasts. These are all items that, when you do them, can save you not only time, but a tremendous amount of money. We've had clients that haven't been able to account for substantial amounts of their income because these forms and services were not provided to them. Very important to get a CPA or an accounting firm that understands the hotel business, understands how to set these things up for you. The costs will save you a tremendous amount of money, well beyond the fees involved in having these things done. And how to make money. Have a comprehensive business plan, owner-specific to you, that has your operating, marketing, cash flow budgets, and gives you a daily guide to your operations. If you go to our website, PhD Financial LLC, you can get more specific information about this. Have a structured revenue management program. This will maximize the returns and income for your property. I'm going to speak now a little bit about debt restructure. At this time, there's 51,214 hotels in this country. And at any given time, 10,000 of those are in default. It doesn't mean that these properties are not paying their mortgage payment. But if you weren't aware of the covenants in your loans, you may be in default without ever knowing it. Not paying your franchise fees, property taxes on time, not providing financial statements to your lender. All of these are just 3 simple ways in which you can be in default of a loan, and there are dozens more. This is a sleep-in in Georgia that we restructured in the last year. It was purchased for $4,250,000. It had EBITDA of $425,000. This was using a 10% capitalization rate of EBITDA to determine its value. EBITDA, for those who don't know what it is your earnings before your interest, taxes, depreciation, and amortization. That's basically free cash available for debt service. This is the main number that banks use to determine whether they're going to loan you the money or not. So in this particular case, this property borrowed $3,125,000. It had a first mortgage of $1,875,000 and a second SBA 504 loan for $1,250,000. We roll the clock forward a number of years, and this property, unfortunately, now only has $150,000 in EBITDA. Using the same capitalization rate, it's worth $1.5 million. Unfortunately, it still owes $3,125,000. So this hotel is $1,625,000 of negative equity, or is $1,625,000 less than it owes. So here's its current situation. We know the property's value is $1.5 million, still owes $3.125, and it has a $160,000 net operating loss after debt service. So this is what we did. We restructured the debt. We determined its value of $1.5 million. It had current balance of $3,125,000. It was upside down $1,625,000. These are some examples of properties where we've had similar successes, and if you go to our website at phdfinancialllc.com, you can look them up and see more specifically what we have done for them. So this is what you do. You don't wait. You get proactive. You plan to restructure your debt. Don't wait another day. Every day you wait makes this process more difficult and the outcome more uncertain. So this is what you do. You continue paying all of your necessary operating expenses, your franchise fees, your property taxes, your sales taxes, your payroll taxes. Most importantly to me, you keep up your property. If you have a ripped shower curtain, replace it. Torn terry, replace it. Most importantly, make sure your staff is being nice to your guests checking in. You have a good front desk people. Banks look at your online reviews. It's imperative that you make sure that if you get a bad review, that you respond to it. And don't be defensive. Just acknowledge the issue and that you've dealt with it. And last but not least, if you're running your property and you're the general manager of your property, take a salary commensurate with whatever general manager would have to be paid in your geographic area, and pay your personal expenses through your salary. Do not run your personal expenses through your business. This also leads to piercing the corporate veil and giving you liabilities that you should never have. Now, back in the 1970s, there's an organization called the Federal Accounting Standards Board. This board controls how banks can handle loans that are non-performing. It allows banks to break your loan up into several parts. In this case, we bifurcated the loan or broke it into 2 pieces. The original note was for $1,875,000. We created Note A for $1.3 million at 4% interest at 30 years. The old payment was $13,500. The new payment was $4,300. Note B, the portion that the property cannot afford, was for $575,000. That note we actually purchased for $57,500, saving 90% of its value. On the SBA second, we settled a $1,250,000 of outstanding debt for $250,000. We paid the SBA $50,000 down, and they took back the balance of $200,000 over 25 years, which created a payment of $666 a month without interest or CDC fees. Upon payment in full, you're released from your personal guarantees. So the net savings here was a principal savings of $1,575,000. They had an old interest payment or mortgage payment of $24,750. That reduced to $5,000 for an annual savings of $237,000. So I like to say hope is not a plan. It's a great thing to have, but again, there's tremendous uncertainty in the world today. If you turn on your TV, pick up a newspaper, that shouldn't be a surprise to anybody. So my plan is hope for the best, but plan for the worst. So my final thoughts are take control of this process. Don't wait. Be prepared to negotiate for months. We've had clients that haven't paid a mortgage payment in 4 years, but yet they're still in control of their property. Know how weak or strong your bank is. We work with most of the banks and lenders around the country. We understand what kinds of programs they'd be more susceptible to taking, and we structure things that are acceptable to our lenders. And we solve the problem once. I have many clients that come to me and say, I can go to my bank and do this. Well, what banks generally do for you is defer your payments, go interest only, but after that deferment period is over, they do what's called recapture. And recapture means that whatever monies were deferred, they get back over a relatively short period of time. So it creates what was a payment to 150% of that payment. If you couldn't afford it then, you can't afford it now. Other people say to me, well, maybe I should just go bankrupt. Well, bankruptcy is an option, but it should be your last option. Most things can be worked out just like they would be in a bankruptcy outside of a bankruptcy. Bankruptcy is expensive, and there's no certainty of a solution that way. 70% of all Chapter 11 reorganizations become Chapter 7 liquidations. So after going to spend $100,000 in your bankruptcy, you may end up losing the property anyway. So while bankruptcy is a bullet in the gun, it should be the last bullet in that gun. Thank you for watching this presentation today. For more information, please go to our website, phdfinancialllc.com, or feel free to call me on my cell, 480-292-1645. Have a wonderful day. Thank you.